What does this all have to do with the stock market? I mean, that's why you're here, right? I want to go through some things about the financial markets from a global perspective, and then I want to go through some very near-term indications of what's happening in the markets. This is the stock market since 2007-ish. Of course, you see the big bear market that happened during that time frame, and the recovery. Now, interestingly enough, the recovery was not a function as much of a recovery of economic growth. The economy's been slugging along at 2% since 2008 on average. So we have not really had an acceleration or a pickup in economic growth, but we've had this massive rise in asset prices. Here's QE1. This is QE2. Operation Twist, which is basically where the government came out and said, hey, we're not going to buy anymore. We're just going to roll over everything we have real quick. And then QE3. What you will notice is that following periods of time where the Federal Reserve is no longer active in the market, you tend to not have very good market activity. The Federal Reserve ended their quantitative easing in October of 2014. And the markets really haven't done a whole lot since then. We've done a lot of up and down. Now, we haven't crashed at this point, but we also haven't made a tremendous amount of gains since the Federal Reserve extracted their liquidity from the market. So in other words, what this is telling you is that at this point, since 2009, the main driver of asset prices has been Federal Reserve interventions and liquidity being forced into the system rather than actual increases in asset prices because of growth in the economy. The correlation is out of whack. If we took this same chart and extracted out as an example, if we just extracted out the impact of Federal Reserve interventions, we would not be trading currently at around 2,000. We'd be trading closer to about 1,600. Now, that doesn't mean that anything's wrong. It just goes to show you the differential between putting $4 trillion worth of liquidity into the financial system and what happens with asset prices. But Ben Bernanke was very clear about this. In 2010, when he launched QE2, the Federal Reserve has two mandates. Their mandates are very simple: full employment and price stability, which is inflation. But Ben Bernanke came out and said in 2010, he says, we're going to implement another round of quantitative easing because we want to ensure full employment and price stability by targeting asset prices to boost consumer confidence. So Ben Bernanke knew that by injecting more liquidity in the system, he would raise asset prices. The idea would make you feel better because your 401k went up, so you would go out and spend more money. You go out and buy a car, you go and buy a house, you do whatever it is you want to do. But here's the problem with this. When I boost asset prices by an artificial measure and I make you feel better, you go buy stuff that maybe you weren't going to buy today. Maybe you weren't going to go buy a new car today. You were going to just drive your Ford, or you're going to drive your car for another couple of years. You were going to stretch it out. But, you know, at 0% interest rates, and I'm feeling better about the stock market, I'll go ahead and buy that car today. What that does is I'm pulling forward future consumption to today. So purchases that were going to be made in the future are now being made today, which does what to the future? It leaves a hole in the future. It leaves a void of consumption in the future. So when we get to the future, we have a slowdown in economic activity. We have a struggle in the markets. And so the Fed has to come in and refuel the system so that you now drag forward the next batch of future consumption. The problem is that every time we drag forward future consumption, we are creating a larger and larger and larger void of consumptive activity in the future that it's going to have to be dealt with. The hope is that somehow we're going to spark a tremendous amount of economic growth and natural activity will fill that void. Unfortunately, we just haven't actually seen that occur yet. But here's the issue, and this is something that we're going to address specifically in the webinar next Wednesday, is talking about what you hear in the financial markets versus what actually happens in the financial markets. One of the things that we hear a lot right now is like, don't worry about your money. Just stick it in the market and leave it alone, and over the course of 50 or 60 years, you're going to be great. Market says so. Long-term market returns 7% a year. Just stick your money in, forget about it, you're going to be good. So what I did is taking that idea, I went back to 1960s, and I said, let's do this. Let's take the financial market. There's the financial market. That's the S&P 500. Let's take the same volatility, the same standard deviation of returns, and let's build a model into the future of what the future might look like. So there you go. That's what it looks like. As you see, you got some big bull markets, you got some little bear markets here and there. But overall, you get a 7% rate of return. Exactly what you had since 1960 till now. So I projected the same thing out. You get a 7% rate of return over the next 30 years. So let's take your money, let's stick it in the market, and leave it alone for that entire time frame. First of all, you died before you got to the end of that time frame. But let's just assume you actually lived that long. So let's assume you lived that long. Okay, here's what actually happens. Did you actually make that 7% rate of return over that time frame? The first thing that happens is psychologically, no, you didn't. Because there are three things that happen to investors that are investing in the markets. The first is that they don't have any capital to invest. That's about 25% of the reason that people underperform in the financial markets. They should invest, but they simply don't have the capital to do so. That goes back to our earlier conversation about wages and the ability to save money. The second thing is that capital was needed for something else. You know, you were going to invest that money, but, you know, the refrigerator broke down, had to buy a new car. So you spend the money for that. But the 50% of the reason that people underperform the markets over time is psychological. It's behavioral based. You do everything exactly backwards of what you should do. You buy high, you sell low, you do all the wrong things. So this is that chart, 7% annualized. The blue, nice smooth graph is what financial advisors and planners tell you. Say, just stick your money in, you'll be great. And over the next 50 years, as you get through retirement, you're going to have $1 billion in your account, and you can go hang out with Warren Buffett and retire. The orange is what happens because of the impact of drawdowns in the financial markets. The yellow is the gap between what's promised and what really happens with your money. So if you do a financial plan with somebody and they say, look, you have $1 million today, and based on the next 30 years of growth in the market, you'll be fine. Don't worry about it. Problem is you probably won't be. The shortfall is what winds up hurting people. And it's worse than that because of the behavioral issues. People do exactly the opposite of what they should do. Now, that's just me saying that, okay? Dalbar is a company that actually does investor research. All they do, Dalbar Investor Research, they do research on what investors' returns are like, what investor behavior is, et cetera, and they've been doing this for over 30 years. This is their study. They look at investor returns in equity funds, asset allocation funds, bonds, and they compare that to inflation in the S&P 500. Let me say something real quick before we get any further. As an investor with your money, your job is not to beat the S&P 500. I know that's heresy, but just hold on with me for a second. You listen to the media, they keep telling you, it's like, oh, if you didn't outperform the S&P last year, you need to do something different with your money. That's not your job. Your job is not to beat some random benchmark index. I just wrote an article about this for Monday. The index has no cash. It has no expenses. It pays no taxes. It benefits from company share buybacks because it reallocates the market weighting of the index. Anybody invested in GM before they went bankrupt? When a company goes bankrupt in the index, in the S&P 500, the S&P 500, the Dow Jones that owns the S&P, they come in and say, well, that company didn't work out, so we pluck him out, and let's put Visa into the S&P 500. Immediately, the index is back where it was supposed to be, and it's all good. It's completely reweighted, market value is great, S&P keeps going up. What happened to your portfolio? You have 500 stocks in your portfolio. You are identically replicating the S&P 500 with your money. You were in GM. GM goes bankrupt. S&P says, so let's just, easy math, you had $1,000 in GM. GM's now worth $100. You only have a finite amount of money. You can't stick any more money. The index can't stick any more money in it, and you can't stick any more money in your portfolio. So your $1,000 investment is now worth $100. S&P says, no problem. Let's just take GM out, and we'll stick Visa in. So Visa is a $100 stock. And you've got to buy $1,000 worth of Visa. Where are you going to get the other $900 from? This is the big problem. What an index does has nothing to do with what happens in a real dollar value-driven portfolio. And this is why there are always substantial deviations, and people come out and say, well, hedge funds and mutual funds, they can't beat the index. They're always underperform. Well, the reason is they pay taxes, they pay fees, they have salaries to pay if they're a mutual fund. There's a lot of things that they have to pay that aren't in the index. Trying to beat an index is like trying to chase a unicorn. If you can find one, that's great, but they're really hard to come by. But here's what happens to investors. So now let's lay on top of the fact that you've got to pay taxes every year, you've got to pay fees every year, and there's nothing wrong with that. That's just the way the world works. But just understand that that impacts your returns. But then let's lay on the psychological behavior. Look at what happened to investors over 20 years. And mind you, this 20-year period included the 5 years running up to in the greatest bull market in the history of the world. They generated on average a 5% rate of return versus 9.2% for the S&P 500. A 40% differential. Over the previous 12 months, this was 2015 numbers. 2014 numbers. They haven't come out with their 15 numbers yet. Market was up 25.54%. Equity investors were. The market was up 32%. Big deviation. But this is the impact of psychology. So despite all of these rosy predictions that if you just stick your money in and leave it alone, the reality is it just doesn't work that way. And the reason is what we call full market cycles. This is one of the most powerful forces in the markets ever known to man. And if you learn nothing else today, please learn this one point because this will save you over the long term, I promise. This goes back to 1900. This is a inflation. Oh, by the way, that's something else that you pay for in your portfolio as well as the cost of inflation. This is the inflation-adjusted return of the S&P 500, and it's on a log scale, so it's a little bit easier to see, since 1900. These are your big bull markets. These are the times that you wanted to be invested in the financial markets. Out of the entire, so I said earlier, remember I said earlier in the show that, I said earlier that the average return since 1900, not including dividends, is about 6%. So this is just capital appreciation right here. 100% of your entire 6% rate of return since 1900 occurred during those 4 periods. Because the rest of the time, you were making up losses. Now, this is assuming that you can all live 115 years. But here's the important point. As you will notice, every cycle, this isn't a bull market followed by a bull market. It's a bull market followed by a bear market. and it is part and parcel of the reality of the physics that apply to asset prices. You create excesses in asset prices on the way up. Those excesses have to be reverted back below a mean so that they can grow again. If I take and I use this example a lot on the radio show, if I take a rubber band and stretch it as far as it will go, if I want to stretch it again, what do I have to do? I have to let it relax first. Physics say that if I stretch a rubber band as far as I can and then let it go, it travels an equal and opposite distance in the other direction before it comes back to the middle. That's what happens with the markets. The problem is that these declines in the markets are what devastate a lot of capital. I just wrote a piece on Thursday, just yesterday's post, talking about 20-year returns. If I invest $1,000 in the markets when PEs are at 10 times or less, I make money over the next 20 years. If I invest $1,000 when PEs are 20 times or higher, as they are today, I lose money in the future over the next 20 years. I lose money over the 20 years going forward for when valuations are high. This corresponds with what's happening here. The average drawdown during a recession has been 33%, about 30% since 1900. So every time there's been a recession, on average, some are worse, some are not as bad, that's averages, we have about a 30% loss. And this is going back to what I was just talking about. If this is the real inflation-adjusted rate of return of the market on a forward 20-year basis, so at any point in history, if I invested in 1900, what was my return on an inflation-adjusted basis 20 years later? If I invested in 1901, what was it 20 years later? 1910, what was it 20 years later? So what this shows you is the forward 20-year returns of investing in the markets. Now, you'll often hear financial advisors, you'll hear this in the media, well, there's never been a 10-year period where you've lost money in the market. Just stick it in. There's never been a 20-year period that you've ever lost money. That's guaranteed. The problem is that they don't adjust for inflation. Once you stick in that nasty little thing of inflation, it's a whole different world. I said earlier that your job isn't to beat the S&P 500 index. You do have a job. Your investments have to beat one thing. That's inflation. Your only target when you're investing money, your benchmark for your money should be inflation. Because this is a little bit of an anomaly of thought, but the money that you're sticking into the financial markets are your savings. These are what you're saving for the future. This is what you want to retire on. This is what you're depending on being there when you get to that point in time. So your job as a saver is that you are putting your money to work to grow it at a rate that will keep that money having the same purchasing power parity in the future that it has today. So in other words, what I can buy for $1 today, I can buy for $1 50 years from now when I'm ready to need it. But if I keep losing it, I'm really not doing myself much good in terms of keeping up with the rate of inflation. But here's the interesting thing about this chart. This is valuations. Do you notice anything suspicious about the level of valuations versus future returns? It's exactly what we just said a second ago. The higher what you pay today, the value of what you pay today determines the future return on investment 20 years from now, 10 years from now, 30 years from now, 40 years from now. If you overpay for something today, what's going to happen in the future? If you went to an auto dealership today or you bought a house today, interesting story, real quick. Donald Trump got beat up by another radio host earlier this week because he took in $500 million from Chinese investors to build a building. China is working as fast and furious as possible, their citizens are, to get money out of the country. In Vancouver, as an example, there was a 600 square foot shack for sale for $7 million. It sold for $2 million over ask. The shack was completely unlivable. You can't live in it. But this is just money that needs to get put somewhere. They need it out of the country, and they're willing to pay anything to get it out of the country and into something somewhere else. But if I overpaid for a house, so if I went to the market today and I said, you know what, I'm going to pick on Rich. I'm going to buy Rich's house. Rich has a house that's $500,000. And I say, Rich, you know what, I'm going to give you $1 million for your house. I overpaid for the house, right? What's going to happen to me 10 years from now or 15 years from now when I try to sell the house? If I get lucky, I might break even. But I've lost, that same amount of time to potentially grow my assets. So the point is that if I overpay for something in the financial markets today at 24 times earnings, the odds of me having a positive net rate of return on a buy and hold basis 20 years from now is likely not good. And this is the real point. Investing at the wrong time, when valuations are high, leads to market reversions throughout history. Hasn't changed. It's not a function. I'm not telling you not to invest, but what I am saying is that it is more important when you invest than if you invest. If you go back through history, these areas are when markets actually made brand new highs. The rest of the time was spent getting back to even. In other words, if you invested at the peak of the market in 1929, it took you to 1954 to get back to even. It's hard to make money getting back to even. I've written this in the newsletter a lot. Getting back to even is not an investment strategy. But this is the problem. As this chart shows here, there's a long-term trend line in the S&P 500 that's been upward elevated going back. And that's fine. What happens is with that trend, the market trades both above and below that long-term trend line. The greater the deviation above that long-term growth, the bigger the reversion has to be to work off that excess. We currently have one of the biggest deviations between that long-term growth rate and history right now. The call by the financial markets is this is just going to keep going up. We're in a brand new secular bull market, considering we have 2% growth, 94 million people sitting outside the labor force, et cetera, so forth and so on. But we're in a brand new secular bull market like we were in the 80s and the 90s when the average households increased their consumption through leverage by $11 trillion.